Hey there, and welcome to this explainer. Today, we're jumping right into what is arguably the biggest debate in modern investing: dividends versus growth indexing. It's basically a tale of two entirely different paths. And look, rather than just throwing opinions around, we're going to rely strictly on the data. We want to see exactly how these two distinct strategies perform, how they actually function, and most importantly, how they feel to hold over a lifetime.
So to kick things off, I want you to think about this pretty wild question brought up in the research from Josh Invests. Can a single ETF actually replace your full-time job? Seriously, is there a single fund out there with the horsepower to completely substitute an entire career's income without you ever having to clock in again?
To answer that, we're going to start with a really tangible baseline: a single $50,000 investment. That's it. No extra contributions, absolutely no monthly top-ups along the way. Just that initial $50K, the fund you pick, and a 30-year horizon to see how this genuinely plays out.
All right, let's dive into this. Here's our roadmap for today. First, the ultimate investing goal. 2, the dividend income engine. 3, the growth fund path. 4, the psychology of selling. And finally, number 5, building your perfect portfolio.
Okay, Section 1, the ultimate investing goal.
You know, every investor inevitably runs into the exact same fundamental problem. You have to find an asset that actually grows your balance, sure, but also pays your bills without forcing you to basically cannibalize your own portfolio. So we're really looking at a bigger balance up against a growing paycheck. Now, massive popular funds like QQQ or Vanguard's VGT, they offer absolutely exceptional price appreciation, but their dividend yields? They are tiny. And the harsh reality is, a bigger balance that doesn't actually pay you anything is just a number on a screen. You can't exactly buy groceries with unrealized gains, at least not unless you start selling off your shares.
Moving on to Section 2, the dividend income engine. Now, what's really interesting about this is that if we aren't selling shares, well, we need an entirely different kind of machine. Let's look at the incredibly rigid rules-based criteria of SCHD. That's the Schwab U.S. Dividend Equity ETF. This fund tracks 100 companies specifically selected for financial strength and sustained dividend growth. It boasts a solid 3.45% yield and literally 14 years of uninterrupted growth. I mean, through the 2020 pandemic, the 2022 pullbacks, it just kept paying. And because it operates strictly on fundamentals, it's constantly adapting. It'll just rotate right out of overvalued sectors to bring in absolute stalwarts like United Health. But, simply owning a fund like this isn't the whole story. The real magic, it all hinges on one simple choice: taking your dividends as straight cash out versus using a dividend reinvestment plan, or what we call DRIP. With DRIP turned on, every single dividend payment automatically buys you more shares. And then guess what? Those new shares pay their own dividends next quarter, which buys you even more shares. It creates this massive snowball effect, automatically compounding your position over time without you lifting a finger.
Listen, the math on this is absolutely staggering. On that single $50,000 investment over a 30-year span, just taking the cash out gives you a very respectable $2,658 a month in income. But with DRIP turned on, that exact same $50K generates $8,528 every single month. That is a $1.43 million gap created simply by letting those dividends reinvest. To put that in perspective, that's nearly double the median U.S. full-time paycheck, purely from money you invested once and literally never touched again. Crazy, right?
All right, let's pivot to Section 3, the growth fund path.
We absolutely have to look at the alternative here, because the data clearly shows that while dividends offer amazing security and income, broad market growth funds historically offer much stronger total returns. And within this space, there are some totally fascinating mechanics at play, like momentum investing. Take an ETF like SPMO, for example. It doesn't try to predict the future. Instead, it uses a highly systematic process to evaluate the S&P 500 every 6 months, and then it heavily weights the 100 stocks showing the highest momentum. The market is already rewarding them, right? And because it dynamically adapts like this, it drops significantly less than the broader market during that brutal 2022 tech correction. So looking at the growth heavyweights, the historical numbers are just wild. VGT, which is Vanguard's pure tech ETF, boasts an astonishing 24.1% 10-year annualized return. But, and this is a big but, it carries intense concentration risk. When tech corrects, it crashes hard. Then you've got QQM giving you roughly 17% annualized with slightly more sector diversification. And of course, SPMO offers that adaptive risk management with smaller drawdowns. Make no mistake, these funds are spectacular wealth-building engines, but we have to remember the golden rule here. To actually get the money out in retirement, you must sell your shares.
Which leads us directly to Section 4, the psychology of selling.
And that brings us to what is arguably the absolutely most critical element of this entire discussion. Because picking an ETF is ultimately about picking the psychology you're going to have to live with for the rest of your life. Really think about what each plan actually feels like in practice. With dividend income, you're experiencing psychological stability. The market might be completely crashing, the sky is falling, but these companies are still depositing cash directly into your account. On the growth side, though, you rely on the 4% rule, safely withdrawing a percentage of your portfolio. But practically, that means during a brutal recession, you are actively clicking sell on your declining, red-bleeding shares just to pay for your groceries. That is tough.
As Martic Finance so brilliantly points out in their research, the biggest mistakes don't actually come from choosing one of these approaches over the other. They come from behavior and panic selling. Staying perfectly disciplined with a boring index strategy during a massive market crash is incredibly difficult for anyone. When the market drops 20–30%, there's no steady income to give you that warm reassurance. It's just declining red numbers staring back at you on a screen.
So the crucial point here is understanding something called sequence of returns risk. Basically, if you retire right before a major market decline and you're forced to sell off pieces of your growth portfolio to cover your everyday living expenses, you are permanently locking in those losses at literally the worst possible time. It's a real danger that can absolutely devastate an otherwise flawless growth portfolio. All right, let's wrap this up with Section 5, building your perfect portfolio.
To synthesize everything we've talked about, let's look at a simulation utilizing 3 Fidelity funds, FDVV for dividends, FNCMX for growth, and FTIHX for international exposure. We'll start with a dividend-tilted portfolio. Right away, notice that massive 50% allocation to the international fund. You might be wondering, why so high? Well, because it boasts an unbelievable 16.98% dividend growth rate, so it acts as the primary compounding engine for your future income. Then, 30% goes to the U.S. dividend fund for immediate yield, and the remaining 20% sits in growth just to anchor the portfolio's overall value.
And the outcome of this specific weight? If we fast forward 30 years, a single $10,000 investment grows into a $416,613 account balance. But the real headline here is the income. This setup generates a reliable $2,048 every single month, for life. And the best part, you don't have to sell a single share to access that cash.
Now, let's move on and see how this builds when we completely invert the strategy. The growth-tilted portfolio puts a whopping 70% directly into the tech-heavy NASDAQ fund FNCMX. This is heavily prioritizing its staggering 17.45% historic appreciation rate. Dividends are basically sidelined entirely here, acting as just a tiny little buffer in the background.
The sheer force of that compounding growth yields a drastically larger final balance, nearly $700,000. I mean, it absolutely crushes the dividend portfolio in total size. But, and this is the kicker, without that income engine, it only pays out a measly $98 a month in actual cash dividends. It represents incredible money on paper, for sure, but almost nothing in your pocket automatically.
And this brilliantly illustrates the ultimate trade-off we've been talking about. Look, if you apply the 4% rule to that massive $699,000 growth account, you can technically withdraw about $2,332 a month. That actually beats the dividend portfolio's natural payouts, but it requires you to actively sell off your shares, which completely reintroduces that terrifying sequence of returns risk if the market tanks. The dividend path yields slightly less per month, but it keeps your core shares completely untouched.
So, we arrive at our final biggest question. The data clearly shows that the right strategy isn't about which one is universally best. It's really about which one you can psychologically endure holding over a 30-year timeline, through every terrifying market crash and every euphoric boom. Do you want the unbreakable peace of mind of a steady paycheck, or do you have the iron stomach required to manage and eventually sell off a massive account balance? The choice is entirely up to you. Thank you so much for joining us on this explainer, and we will catch you next time.